Well, hello there, and welcome to this live event on the 5th of May 2020. This is the pre-show bit, so we'll just wait a couple more minutes, waiting for people to come in. We've already got nearly 300 on the stream already, which is great, and been enjoying the pre-chat. Haven't necessarily said hello to everybody, it's just been rather busy doing a few other things to get sorted out. I'm just going to put my pre-show banner on, but good to see everybody on, and hopefully the stream is working as it should. YouTube says I have an excellent connection, which is good, and everything looks pretty sweet here at the moment. Got a lot to get through tonight again. There's so much going on. I don't know. I have to say that I spent a fair amount of my time trying to absorb all the new information that's coming in, and then trying to sort of feed it into the models and then think about the implications of it. It's quite tricky sometimes to do all that. But the rate of flow is just amazingly strong at the moment. So one of the reasons why we're doing this every couple of weeks rather than every week. Plus, of course, perhaps people have a bit more time. So that's very good. Seen there's a few questions there about property prices in particular areas, and I will talk a little bit about our methodology and how we get down to postcode level, but I don't necessarily publish all that information on a regular end. Good. Thank you very much for the feedback to say that it sounds good. We do try and get the production quality reasonable on the stream. I've had a few people ask me about the way we do that. There is a video that you can look at. I made it just after the new year, which walks around the studio and explains the tools that we use to make the show. So have a look at that if you're interested in a bit more background information. I'm just going to run this for one more minute, and then we will get going. And Phil, yes, I have thought about expanding the staff DFA. My wife and I basically do this together. It's a bit tricky at the moment given the current uncertainties about the economy as to what to do, but you know, I have thought about it, and with all the modelling we could do if we have more time and effort, it may be worth it in due course, but we'll see how it goes. Okay. Just going to wait another 30 seconds and then we'll get going. There's quite a few people on. Good to see everybody there. Hi Ron, good to see you, and Billy the Kid, and a few others there. It's nice to see some new names as well as some of the familiar names. Madeline, hello, good to see you. And it's good that the message is getting out about DFA and what we're doing here. So please share, please like. Please make sure that more people know about what we do on the show here. All right. Well, I'm going to switch over from pre-show mode, and we're going to run the DFA intro. And we'll get going. So let's start. Hello there, it's Martin North from Digital Finance Analytics. Welcome to our live stream on the 5th of May 2020. And it's great to have you all on board. This is the second, if you like, emergency post that we've done. We normally do it every month, but we've been doing it every couple of weeks over the last little while because there's so much going on. And of course, today the Reserve Bank did their normal trick, which is to publish their minutes today. And we'll talk about those in a second. So just to explain what I'm going to do, I'm going to spend the first part just going through some introductory remarks, share a few slides, and then from there we'll be able to get back and talk to the live stream, answer some of the questions. I've also got a bunch of questions that people sent me in beforehand. So that's the way we're going to do this. So I'm not looking at the stream now, so if you're leaving comments and questions for me, just understand I'm not going to pick them up for a little while. I'll try and get back to them later. So in terms of what we're going to do, we'll just go through our normal introduction first. The running order is this introduction, house rules, about our models. I always spend just a moment or two on the models simply because a lot of people won't know the way we come to our analysis and decisions, and it's important you do that and understand that. Talk about some of the key data that's come out today. There's a lot of information that's come out today. And then there'll be questions and answers. Typically this show runs for about an hour and a half, give or take. And depending a little bit on how much enthusiasm there is, it might go on a bit longer or a bit shorter. And we'll sign off at the end of that. As normal, this is going live to YouTube at the moment, but we also put an edited version up subsequent, and that edited version also has a little bit of view from my other camera, so you can get a bit of a sense of the room that I'm here to. Andrew, appreciate that. Thank you very much. It is so much appreciated. It makes a big difference. In terms of house rules, just to say this isn't financial advice. I have to say this every time because, I don't want people to misinterpret what I do. I don't give specific financial advice. I'm not a financial advisor. I'm not paid to do that. What I'm doing is sharing my research and my analysis of the news. And if it helps, that's great. But if you want detailed financial advice, then go find a financial advisor. Please play nice in the chat room. It is being moderated. No racial slurs, please. There are some very, very good conversations that go on during the show, and that's great. I want to encourage that. But we don't need, and there's no space for racial slurs and those sorts of things. This is as of today, the 5th of May. Down the track, who knows whether I'm right or whether I'm wrong. It's based on what I'm seeing today. But if you're watching this in 10 years' time, you'll know whether I was right or whether I was wrong. Please use Walk the World, @Walk the World, to get my attention because there's always so much going on the stream. I don't necessarily have a chance to read every single comment. And I must be honest with you, sometimes people get a bit frustrated that I don't see their comments, but if you don't use @Walk the World, I'm afraid that I may miss it. Nico, thank you so much. Yeah, it's interesting that the gold mines are up a lot today. There's quite a lot of interest in gold. We might come to that a bit later. I have enabled Super Chat, as you've seen. A number of people have already put comments in. And a couple of points there that you can actually make sure that your comment is actually given pride of place and gets my attention, firstly. And secondly, it is a way of your being able to support our work. We don't make any money or profit out of this. This is simply a way of giving back to the community. So if you are able to support us and help us, it just enables us to make more great content. So that's the way that it works. Now, just in terms of my models, this is just a little bit of background. So we survey households and SMEs on an ongoing basis. We pull information from a whole bunch of other sources, and then we put them into our core market model. And that core market model is essentially the analytic tool that we then use to be able to power the blog, to power the YouTube channel, and to be able to provide information directly to our clients, some of whom pay for that information, as well as to the media and other channels too. And we've been doing this since 2010, 2011 in this format. Prior to that, we were still running the analysis, but doing it in a bit of a different way when we work for a larger organization. We overlay this DFA segmentation, and that allows us to slice and dice the data lots of different ways. So whether you want to look at it by geodemographic, or whether you want to look at it in just a geographic perspective or property status perspective, all those different factorials are there. We actually run information down to a postcode level. So if people are interested in particular postcodes, we actually have data down at that level. But of course, we quite often don't actually share that to everybody. And now just the RBA today. So they released their minutes, and the first thing they said was that they're going to maintain the current policy settings. So the 25 basis point cash rate and the 3-year government bond target rate of 25 basis points. So that's their fundamental lever that they've been using. They also said that they've scaled back the frequency of bond purchases. And I'll come on to another very important development shortly when we've discussed this, because there was something else they said as well, but I'll touch that separately. They've continued to say they'll do whatever necessary to ensure the bond market remains functional. And this mantra of doing whatever is necessary is being used by central banks around the world. The Fed said it, the Euros have said it too, as well as the guys in New Zealand. So they are fixated on a particular model that they work with, and Thank you, Ron. Appreciate that. They are fixated on a particular model and a way of thinking about the situation that we're confronting at the moment, and they're pulling a set of levers, and those levers are pretty consistent across most of the central banks around the world. Now, they said that the outline in their baseline scenario is a fall of 10% over the first half of 2020 and around 6% over the year as a whole. And then they forecast a bounce back next year of 6%. Now, there are other scenarios. They're going to publish those on Friday. There's going to be the next big publication from the Reserve Bank, and we'll cover that on Friday when it comes out. And they also say that in this scenario, the unemployment rate peaks at around 10% over the coming months. 10%. Remember, it was at 5.2% before this all started. And it will still be above 7% at the end of next year. So the Reserve Bank is saying that unemployment will be considerably higher than we had before we went into the crisis. Now, they said that the unemployment might be lower, the unemployment rate might be lower, if in fact more people left the industry, left the market and decided not to work as long or just give up looking for work. And they also said that the inflation rate will stay below 2% for the next few years. There was a bit of a blip because of the large purchases of toilet rolls and those sorts of things, but that's just a blip. That's nothing real. So basically, they're looking at 1 to 1.5% in 2021, so way below their target, way below. And they've said that they will not increase the cash rate until progress is made towards full employment, and they're confident that inflation will be sustainably within the 2-3% target band. My own view is it will be almost impossible to get to 2-3% based on what they've been doing. And I'll come back to that. Now, I just want to highlight this. This is from Bill Evans at Westpac. The governor pointed out that purchases would be expected to be smaller and less frequent when he spoke in April. However, he's now indicated the bank is prepared to scale up purchases again. That's quite an important change. And that theme is prepared to support the markets because basically they've decided to broaden the eligibility of collateral for their repurchase operations. So repurchase operations are where they buy assets and give money back to the sellers of those assets to enable them to do things with it. So what they've done is to say that they will now cover Australian dollar securities issued by non-bank corporations with an investment grade rating. And that's quite interesting because that basically opens the aperture a bit more to buying more stuff. Now, it's worth saying that other types of assets, there's no change. And you could argue that the overall impact will be quite small because essentially there isn't a huge pool of these particular class of assets. But nevertheless, it's quite interesting that the Reserve Bank is actually expanding the aperture. Around the world, we're seeing central banks buying up lots of different types of assets and securities. And I'll show you a bit later what the Fed is doing because the Fed's basically made some further announcements too. Now, the Treasurer spoke at the press club today, and he said that the reduction in economic activity since COVID hit is about $4 billion per week. And he's warned that the economic shocks associated will be profound and prolonged, with Treasury estimating a 10 to 12% fall in gross domestic product during the June quarter alone. So that's a big dip. They also made the point that if they had throttled back the economy as much as Europe had done, then it would have dropped to 24% or $120 billion. So it's quite interesting just understanding the calibration in their minds as to what they've done and the impact. Now, that $4 billion reduction comes from a combination of reduced workforce participation, productivity, and consumption. And he's warned that economic conditions will get considerably worse in the period ahead before they get better, because the sectors hit hardest by the distancing restrictions since the middle of March are the big employers. That includes retail and hospitality, and they employ more than 2 million Australians. So there's a lot of the population in employment terms who will not be back anytime soon. And they also made the point that the credit card data showed that while there was a bit of a peak earlier on, that's also dying away a bit too. So people are buying less, and that means that consumption is definitely degrading. Now, they said that the economic shock is much broader than the impacts on those sectors, GDP is now expected to fall significantly, with Treasury forecasting a fall in the June quarter equivalent to around $50 billion. That's a big number. And they're forecasting a doubling in the unemployment rate. And they made the point that in the 1990s, the unemployment rate increased by 5% over 3 years, but it took 7 years to get back to its pre-crisis level. So now the question will be, if it doubles from where it is, so let's say 10%, how quickly will it come back down? And that's one of the very important unknown unknowns at the moment. Some people are saying it will drop back quite quickly, but many people are saying it will not drop back quickly. And remember that these numbers are on the ABS basis, which aren't really a true and fair reflection of the total unemployment story, as I'll show in a second. And he also warned about the risks of rising protectionism because of the pandemic, particularly internationally, because that has a very significant impact on, of course, not just ourselves, but trade relationships with other players around the world too. Now, the ABS released some data today, and they showed that between the week ending the 14th of March and the 18th of April, employee jobs decreased by 7.5%, and the total wages paid decreased by 8.2%. And in that time, somewhere between 650,000 and 700,000 people lost work since mid-March. And you can see that there are variations across each of the states. In fact, Tasmania, at 9.3% down, was the worst in terms of change in total wages. And the Northern Territory was 9.2, then Victoria 9.2, Western Australia 9, Queensland 8.3, and then if you look at Australia, it's 8.2, and New South Wales 7.5, South Australia down 4.5. So it varies across the states, and it varies around the traps quite significantly. Now, the other point to make is that the ABS said, and it doesn't impact everybody the same. So different industries are being hit. So accommodation and food services down 33% in terms of employee jobs, and arts and recreation services decreased by 27%. Those are both big employers. And the total wages for accommodation and food services decreased by 30.3%, and recreation services decreased by 17.3%. So this is another example of where the real pain is being felt at the moment. Now, the other point to make is that the official unemployment may be still relatively low, because basically in March it was 5.2, and as Roy Morgan says, it will be a little bit higher this time. But Roy Morgan calculates unemployment on a different basis. And essentially they come up with a number of 15.3% now. Now, 15.3% is a pretty high number. You can see how much it's peaked up. And if that basis is used, then the expectation is that unemployment could be as high as 19% on the same basis ahead. And if you look at unemployment and underemployment on the Roy Morgan number, it's a quarter of the population. So a quarter of the population are unemployed or are not working the hours that they want to work. And that's very significant. It means they don't get the hours. And again, they're saying 670,000 have been made redundant. So there's a bit of cross-correlation there. Now, the ANZ Roy Morgan Confidence Index came out today, and basically that was very negative again. It bounced a little bit, but it's still deeply negative from where it was previously, and was significantly lower than where it was in 2009. So that confidence level is quite significant and important. We'll be publishing our own data on household financial confidence in the next few days. But we have already released now, this is the first time we're exposing this information, our mortgage stress data. So we've run our models to the end of April, and now we've moved up from 32.9% of households before the crisis to 38.8%, or 1.4 million households, up 100,000 over the month. Now, this is taking a view based on cash flow, money in, money out. Have they got enough money coming in to pay all the bills and pay the mortgages? And we've taken account here of the government supports, including JobKeeper and JobSeeker. Jeffrey, thank you very much. Really appreciate that. Thank you. Plus mortgage repayment holidays. I've got all of that in the model, and I've taken all of that into account. So despite all of the support mechanisms that we have in place at the moment, mortgage stress is still rising. And my own projections still are that by August, based on current projections, we're going to see mortgage stress up at around 41.7%, which is horrendous. That would be the highest it's ever been, despite the fact that interest rates are rock bottom, despite the fact that we know the unemployment may come back a little bit later in the year. But I've deliberately picked August because in September, it is likely that the mortgage repayment holidays will come off and the job seeker and keeper programs will be changed. In fact, they announced today, the Treasurer announced today, that job seeker would revert to its pre-COVID level. So they'd cut it back to where it was. So there's a very strong indication from government that they want to have a curtain come down at the end of September and get back to a more normal economic scenario. That, if that's true, will almost certainly lead to a further spike in mortgage stress, and we'll model that later on. Now, it hits all the states, but the state with the worst mortgage stress levels on a percentage basis is Tasmania, then South Australia, and then Western Australia, then Victoria, ACT, New South Wales, and Queensland is bringing up the rear. So that's still well over 30%, but in Tasmania, you can see there that it's pretty much sitting around 50%. That's a big deal, and there's a reason why Tasmania is feeling it. You saw some of the earlier data showing that the job drop in Tasmania has been most significant. A lot of it's to do with tourism, and of course tourism's pretty much turned off at the moment. JKD, thank you very much. Appreciate that. We are keeping it up. That's the plan. And we can also look at across our segments. So young growing families, the highest level of mortgage stress, around 70% of young growing families. A lot of first-time buyers are in that group, including people who bought recently under the new first-time buyer scheme. We've also got then large numbers of people living out on the urban fringe, and often in these new high-density estates, and also in high-rise, so the disadvantaged fringe and the battling urban. And then we've got other categories like mature, stable families and exclusive professionals who are also being hit. And exclusive professionals and young affluents are both segments that are relatively affluent and are not used to dealing with the financial pressures that are now being confronted with. And many of these also have properties by way of property investments as well. So many of them are struggling to be able to deal with their own financial situation and the fact that their property investments are now actually not cooking as they would have liked them to have been. Now, in terms of the stress postcodes, again, I list these out every month, and Berrigan-Harkaway, that's 3806 down in Victoria, has the highest count of those in stress, followed by Clarkson and Tamla Park, that's 6030. Stevie, thank you very much. I appreciate that. Steve, thank you very much. Appreciate it. Then we've got Ballarat, and then we've got 3030, so that's Durham and Werribee. And then we've got a couple more Victorian postcodes. So there's something going on in Victoria which is putting considerable pressure on households. And I think it's to do with the fact that there was quite a buoyant property market over the last 18 months. Thank you very much for New Zealand dollars. I appreciate that, Chris. Thank you very much. But the fact of the matter is that it's not just Victoria. So we've got Launceston, for example, in Newstead, 7250. And we've got postcodes up in Queensland too. So you can see there some of the postcodes that are really being crunched at the moment. And, 3977, which includes Cranbourne, has Stafford. Thank you very much. I really appreciate it. Thank you. Cranbourne 3977 has one of the highest risk of default profiles across the country at the moment. So that's something else we model. So mortgage stress is effectively looking back from here and saying, are people currently struggling to make their mortgage repayments? Mortgage delinquency and default is looking forward over the next 12 months. So it's a prediction. And you can see there that I'm predicting that those particular postcodes, particularly the Cranbourne postcode, is going to actually have significant issues. So we are continuing to see this develop. And I just want to remind you that I identified Mandurah over in Western Australia 2.5 to 3 years ago as a high-stress postcode. And if you look at Mandurah today, you've got high levels of unemployment, you've got a lot of property on the market for sale, you've got a lot of social issues over there, and prices have dropped 20 to 30% from where they were. So I'm afraid that that's a bit of a bellwether for what I think is going to happen more broadly. Now, we've also modelled rental stress, because rental stress is quite important too, because there's a third of the population who are actually in rented accommodation. And what's interesting about this is that we estimate there's 1.7 million households out of that, 3 to 4 million who are renting, who are in difficulty. 39.3% of those renting overall are in rental stress. So again, it's defined as a cash flow. Have they got enough money coming in to be able to make the rental payments that they actually are due to make? And you can see there that again, it's Tasmania, South Australia and Western Australia leading the way. You can see that Victoria, New South Wales, a little less depressed in terms of the total percentage, but nevertheless, of course, in terms of numbers, it's quite big. And then here is the segment view. So you can see young growing families, disadvantaged, fringe, battling urban, same sort of profile. So a lot of the issues are the same, whether you are renting or whether you are holding a mortgage in those same postcodes. And that's one of the reasons why I think this is a big, big deal. The fact of the matter is that we have a lot of people who are really under the gun at the moment. And as I showed you from the ABS statistics, it's a huge, huge, huge problem, I think. I can also just want to highlight that some of the older households, so the stressed seniors and the wealthy seniors, are also finding it difficult too. And that's a big deal because the stressed seniors have almost no way out. And we're certainly seeing a lot of them exhibiting some of the early signs of significant financial stress at the moment. And just in terms of the postcode, so this is the way it's come out. This is again is the top rental stress postcodes, and Melbourne postcode 3000 is actually the most stressed rental postcode across Australia at the moment. And that's partly because there's a lot of high-rise buildings in and around the centre of Melbourne. The rents are quite expensive there, and many of people, of course, have essentially got no way out. So that's part of the issue. But then you can see we go up to 4350, and then we go across to 4870. So they're actually Queensland postcodes, 2170, places like Casula, and 4300. So you can see there the different postcodes across the country. So you've got to picture this as hotspots. I want to highlight 2026 Bondi. You wouldn't have necessarily thought that Bondi would be one of those postcodes with high levels of rental stress, but a lot of people are renting there. A lot of people are actually in those particular industries where they've got gig jobs, and therefore they're significantly impacted by what's happened. And so that's one of the reasons why some of those postcodes are now bubbling up. And people have been saying 799 was the peak concurrent. So if we get over 800, hey, did we get to 800? I think we might have. Cookie Boy says yes. So there's a little bit of an in-joke here. Cookie's going to make a donation to charity if we get about 800 on the stream tonight. So you could well be up for it, Cookie. I appreciate that. Let's see, shall we? Okay, now the other thing to say is SQM published some information today, and they said that residential property listings decreased in April by 4.9% from 307,847 to 292,775, and listings are down 11.9% compared with 12 months ago. All cities experienced decreases other than Canberra, who was up just slightly, and the biggest decrease was in Perth with 8.4, followed by Sydney 7.2, Darwin and Adelaide were also lower. Hobart had the smallest decrease. And the year-on-year listings were more significant declines, with Sydney recording a decline of 19.4%, followed by Darwin at 17.7%. So that's a very important indicator, right? So what we're seeing, 811. Cookie, way, look at that. So what we're seeing is now a lot of people saying, I'm not going to put my property in the market, I'm actually going to withdraw. But we're also seeing some forced sales coming on stream as well. And I'm going to update those forced sales models next time we speak, because I'm looking in more detail at the motivations as to why people are selling. What I can say is more than 9% of property investors are looking to try and sell, but less than 2% now, it's 1.7 or 1.8% of owner occupiers are actually currently being forced to sell. And it's not to do with the banks, it's to do with essentially their view that property values are going to go falling and they want to try and release equity before it's too late. Yeah, and Amit, you made a very interesting point there. 3,000 is, of course, international students. It's another one of the critical points. Many of them are not actually able to meet their requirements. So good point. Thank you for that. As you will understand, as you go down into detail and look at individual postcodes, there's a lot of different dynamics going on, and it's hard for me to be able to go into a lot of detail on this particular conversation. Now, the mortgage index, this is CoreLogic's mortgage index, showed that on a month-on-month basis, nationally, mortgage activity is down 16.5%. And we're seeing that in our own data. So less people are taking mortgages, and that's partly because the banks have tightened their underwriting standards. It's also the fact that people are not trying to buy. Now, they also make the point that on a trend basis over 3 months, it's come up a little, but I'm not going to worry too much about the trends. I think the monthly information is the most relevant. So to my mind, we're going to see more and more difficulty in the mortgage sector ahead. The banks are continuing to tighten their standards. I made a post on that yesterday. And they're asking for a lot more information. They've selected some industries where they don't want to lend to, and some of them are now not lending off the plan either. So expect mortgage momentum to continue to effectively weaken. Now, of course, there's a huge amount of pressure to pull the property lever to try and get the economy back. And New South Wales is just a case study. So, for example, they've opened the doors to property inspections and auctions. And one of the guys on Twitter today said it's interesting that they've opened properties for inspection before they've opened churches. You know, it just seems the priority seems all over the place. They are desperate to try and actually drive the property sector. And of course, they've also announced the fast tracking of a number of major projects. That's been announced over the last few days. They've compressed the approval time frame, and some of these are big constructions of thousands and thousands of units, high-rise units in particular areas. It's all about trying to drive the economy, i.e. using property again to try and drive the economy higher. I have to say I'm disappointed that we're seeing it, but I'm not surprised, because as I've spoken about before, these are unnatural acts. This is typical of what we see from both state and federal government. It's using the property sector as the momentum to try and drive the economy. It's a very weak lever at the moment, and I'm not sure it'd be successful, but it's interesting to see. And remember this, we have more than 1 million properties vacant across Australia at the moment. So it's not that we have undersupply of property. So you've got to ask the question, why are they doing it? Well, the answer is they need the money. They need to try and get more people into work. And of course, if they do sell, then at the moment they get stamp duty, which takes us to another topic. And in fact, I had several people ask me about this, about stamp duty. So there's a debate going on at the moment, should we abolish stamp duty? And McGrath put up a post quite recently saying stamp duty impacts our ability to move house. So his argument is remove stamp duty and you move away a huge impediment out the way, and people can transact, so people can downsize or upsize or whatever more equally. And that's sort of true, because the stamp duty is a considerably large cost when you move. But you've also got to ask this question. If you take stamp duty out of the equation, where is New South Wales going to get that $8 billion that it gets from stamp duty? They've got to get it somewhere else. So it's either got to be a property tax. So what the property spruikers are suggesting perhaps is that rather than actually that money coming from stamp duty, it should be spread across all properties. So you and me, as existing property owner, may have to pay something more. We pay rates, of course, to the local authority, but pay something more too. So just, when you think about this debate about stamp duty or not, you've got to ask the question, how is it going to be replaced? And it's worth saying that 2 Treasury Secretaries wanted to axe the tax, not surprisingly perhaps, because it's not necessarily a very efficient tax. But I am quite concerned about this drive, and I have to say that I've done some research around the world. There isn't a huge amount of evidence that removing stamp duty fundamentally changes the property market. What tends to happen actually is that prices go up by roughly the amount of the stamp duty that's taken away. So we could end up with prices just going higher, which means that nobody wins other than the local authorities and the states losing an income flow that they currently get at the moment. So to me, it's not proven that stamp duty is actually a good strategy to pursue. And somebody just noticed they're saying it's also in a similar amount to the real estate charges. Yeah, that's a good point. So we have the view that real estate agents who are struggling at the moment will have to find different economic models to be able to keep their businesses afloat. Now, just a couple of broader things before we get to the scenarios. So just worth highlighting, the Fed's announced they're going to buy 2 corporate lending programs. They've announced up to $750 billion in debt and exchange-traded funds under its emergency coronavirus action. So again, the Fed is now grabbing other types of assets, including our EFTs, and Mnuchin is issuing $3 trillion in debt. So this is Treasury Secretary Stephen Mnuchin plans to boost US borrowing from April through to June by an unprecedented $3 trillion to support an economy entering a recession caused by the coronavirus. Treasury said the increase is driven by new stimulus spending legislation and tax receipts deferrals, steps taken to help the economy overcome social distancing measures that shuttered businesses. So this is remarkable. Again, more debt being thrown at the problem. But it's really important to ask the question, as I keep underscoring, when these central banks do what they're doing, or when the Treasury is doing what they're doing, who's in receipt of the money? And more of it's still going in to the financial system and the corporates that are connected to the financial system rather than real businesses and real households. So to my mind, this is just more of the same old, same old. It's propping up the financial system, but it isn't necessarily propping up the real economy. And just on China, there's some data showing that they have come back to life a little, but this is actually really important to understand. They are still well below where they were. And if you look at subway travelling, it's noticeably below normal. If you look at passenger load factors in domestic flights, they stabilised at around 70%, and daily coal consumption is still down a bit, roughly comparable with last year, but not huge. And this is the point. This is the question. Is this going to be a V-shaped recovery? Because if China is leading the way in, it's leading the way out. China is not exhibiting a V-shaped recovery at the moment, and indeed, I think it's true to say that it's very likely that the numbers coming out of China are probably overstated relative to reality. Now let me talk about the scenarios just briefly. And as you know, I drive the scenarios out of the back of the model. And this is updated as at today, based on all the information that I came through from all these sources that I've been touching on today. And scenario is just a way of thinking, so I'm not saying these are predictions, they're just indications of the range that we could see. I've also basically assumed that COVID is going to be about a 6-month episode. It could be longer, could be shorter, as you'll see in a second. And this is based on where we are today. So you can basically go down my standard scenario list. So I've basically got 5 scenarios. I've got a little local difficulty, a short-term wonder, a longer-term crunch, a global disruption, and an uncontrolled pandemic. Now, I think that we are somewhere between a longer-term crunch and global disruption. I've actually taken the percentage down, so 50% now for a global disruption rather than 65%. I've increased the probability of a longer-term crunch, but effectively a little shorter with a little bit more of a recovery. But what you can see there is that I'm saying in 24 to 36 months' time, we're going to have an unemployment rate of 8 or 9% or more. We are going to have mortgage stress levels up around 40%. We're going to have considerable rising bank losses, and all the information from the banks over the last little while suggests the losses are probably going to be closer to 40 rather than 19. And the home prices on average, 20% to up to 45%. Now, it depends a little bit on where you look, houses versus units, East Coast versus West Coast. And in fact, I was involved last night on 7:30, ABC 7:30, when I was talking about some of the behaviours behind this. They made a few grabs of what I said. If you are on my Patreon program, you can actually go and see the raw recording of the interview that I actually made, because we spoke for about 8 or 10 minutes. They didn't use all of it, so have a look. But essentially what I'm saying is there are going to be drops. I can't see any route to higher home prices over this period at the moment. And I know that Joy is saying prices are going to go up. Almost nobody else is. And it comes fundamentally back to the debt question. So if debt is important, as I believe it is, and that's fundamental to supporting the momentum, and if mortgage lending is going to continue to be restricted for the reasons we've highlighted earlier on, and if unemployment is going to stay high, I don't think that we're going to see prices go higher. I think prices will continue to fall. I've also just kept there the uncontrolled pandemic. There's a risk that we get a second round and it takes off again, the virus takes off again. If that were to happen, then we know that the economic impact would be longer and deeper. And the fact of the matter is, it's not looking too good. And somebody's just highlighted the fact it doesn't add up. Maybe it doesn't, 50, 60, 75, 80? Yeah. What happened to the other 20%? Good question. I think actually the answer is that it should have been put into the longer term crunch. So that should be 35%, not 25%. I apologise for that. Thank you for pointing that out. That's why I was talking about those two. So it's somewhere between those two at the moment. It's 35 to 50 in that area. And we'll be modelling it again going forward. And Anne said, but it doubles every 7 years. Well, maybe. I don't think that's going to be the case. All right. So there you go. That's the latest on the scenarios. And sorry that my maths didn't quite translate. That was a mistype. It's not in the model. It was just me mistyping it when I put it in the PowerPoint a little while ago. Okay. So with that, let's now go to the Q&A. And what I'm going to do now is I'm going to come back to the main camera, and I'm just going to come back to having a look. I'm just going to go back up to the top of the stream and just see what people were saying and whether there are questions. So we did get to 906, Cookie. 906, that's not bad going, is it? Hey, okay. Let's have a look. What else have we got? Thoughts on property land tax over stamp duty will be appreciated. Well, I've done that one, so I'm quite doubtful as to whether this will have any real positive impact. And frankly, where stamp duty has been taken out, prices have gone up. So expect prices to rise if they do this. Banks expecting property to drop 20% plus. Hence, how could they lend to anybody with an LVR of more than 80%? Yeah, Phil, that's a very good question. The banks are in a bind now because their portfolios are now clearly indicating falls in property values. And they are required to mark their portfolios down when they are sure or pretty sure that's the case. So that tells you that they are unable or unwilling now to lend as much. That's one of the reasons why the lending ratios have been pulled right back. So we're seeing people, lending less. What I will say, though, is a number of lenders are still taking account of those government support programs and counting that income when they do the calculations. And we're still seeing multiples of income at 6 and 7 times in Sydney. So they still haven't really learnt the lesson. This is a really, really important point. If you are a borrower and you're thinking of getting a mortgage at this time, be really, really careful, because the banks are still too willing to lend even now. And whilst they have obligations around responsible lending, ASIC has toned those down a little to basically say you can actually look through the immediate issues if there's an expectation of a longer term, more stable income the other side. That's a big problem because nobody knows whether that's going to actually happen or when this is going to actually adjust. So to my mind, be really, really careful. Okay, Andy's asked, is the mortgage in holiday the same as hardship assistance and only available once? So the hardship program has been in place for some long time, and essentially it's a set of conversations between the bank and the borrower. So you need to go up to the bank and say, look, I've got issues, and they are then legally obliged to assist. And that assistance could be multiple different things. It could be restructuring the loan. It could be interest or repayment holidays. It could be other conversations, including an agreement to sell the property. Now, the mortgage holidays really isn't quite the same as a hardship scheme. It's a different scheme. And I published some statistics earlier on that the ABA published. I think something like 350,000 households have actually taken advantage. Actually, what's interesting, though, if you look at those in mortgage stress, nearly 2/3 of those in mortgage stress have not been able to get the mortgage deferral payments, because essentially the banks are making calculations all the time as to whether this household is going to be in a position to recover or not. So a lot of the hardship payments and a lot of the mortgage repayment holidays have gone to the slightly more affluent households, the people with investment mortgages, for example. So we want to watch this space, because there seems to me to be a gap at the moment between where the interest and principal repayment holidays are actually hitting, which pushes then people back onto the hardship conversations. And those hardship conversations basically protect them for a limited amount of time, but at some point it essentially will stop. And the principal and interest holidays at the moment are due to stop in September. So it's not like it's a completely perpetual process. Shanti says, lazy economics and politics. Yep, that's about it. There's plenty of that around the place. And, the fact that people are actually stimulating the financial system and supporting the financial system, betting on property. And the other thing that we're going to watch for is the resurgence of the arguments about migration. Of course, migration is zero pretty much in Australia at the moment. And migration's been the strongest economic driver for a decade. So without migration, you don't have demand for property. If you don't have demand for property, then essentially everything else just falls away as well. So this is a very important thing. Thank you, MC Nest. Appreciate it. Okay. Okay, now, Dee says, thanks for all that you've done for us. Much appreciated. With all the info available to date, where do you see the property market in Victoria in the next 6 to 12 months? Okay, so Victoria, you need to separate from the high-rise and houses. Houses close into the centre of Victoria will probably do quite well, but there's a limited supply and strong demand. I think apartments and high-rise in particular are in for a real bath. They're at least 40% overvalued, and we also know that there are still some very high-level construction issues in a lot of those ones that were put up. So expect to see price falls there. Further out, where you've got those big estates, both to the east and the west, down towards Dandenong, for example, and across towards Werribee, there's a lot of property already on the market for sale. Prices will fall quite considerably there. And in the regional areas like in Ballarat, for example, I'm forecasting considerable price falls. It hasn't risen as much out in Ballarat, but nevertheless, there is still room to fall. So unfortunately, for many of the urban centres, we're going to see quite a lot of price falls. In the regional areas where prices have just run up less strongly, I think the corrections will be quite a lot lower. But there are also a number of people who've bought investment properties in those regional areas and now are unable to get tenants for them. And some of those were ex-Airbnb properties, and a lot of those are now looking for long-term rentals or are on the market. So ex-Airbnb properties are, I think, going to be a very important development here. And as I said on 7:30 yesterday, about half of those properties for investment owners that are now trying to sell are ex-Airbnb. Okay, Cookie Boy says we need new industries, solar, drought-proofing, EV vehicles. Yeah, I agree. We need a different economic path from this point. We can't just go back to where we were and say, right, bring the migration back and build more property and everything will be fine. That is a recipe for absolute disaster in my view. There has to be a focus on new things, innovation, focus on manufacturing locally and being creative and creating new things. And I think aligning to some of the green initiatives makes a lot of sense. And I did a post quite recently with Robbie Barwick on the need for a bank that could support that, because frankly our commercial banks are not interested in supporting new and innovative businesses. In my surveys, a lot of businesses struggle to get the finance that they need to grow and develop and to innovate. And that's a big deal. So my view is that the finance structure has to be put in place. The political will has to be put in place. And if we can do that, then there is a chance to lay the foundations for a much more vibrant and diverse economy. Because at the moment, if you look at our diversity, we have as much diversity as some African countries, in other words, very little diversity. We are totally reliant on a few industries, some of those going out of fashion. For example, if you look at coal, interesting, Westpac said they're no longer going to support new thermal coal initiatives into the future. So around the world, coal is becoming more of a hazard rather than actually an opportunity. We have to find a new path. And I hope that this COVID reset gives us the momentum we need to set it off in a different direction. We can't rely just on property and digging stuff out of the ground. And by the way, we can't just rely on household expenditure and retail either. Retail, I think, has been changed forever by this as well. And somebody said high-speed rail. Yeah, I think high-speed rail will be one of the interesting things. I've been speaking to the people in Canberra quite often about how you could actually build a strategy to change the means of travel and transport, and perhaps build then along those corridors and basically change the topology of the housing developments, so that effectively you've got more of it built around those corridors. But that takes vision, all right? And that's beyond the 3-year cycle. Unfortunately, we have a political cycle which is really driving everything at the moment, unfortunately. Okay, let's have a look. Nigel said, I sold in December 2016. I won't buy it for several reasons, but stamp duty is in the top 3. Yeah, fair enough. I mean, stamp duty is a big hit, particularly if you're buying a largish property, and that does actually change people's attitudes. But as I said, the problem is if you just take stamp duty away, price will just go up by the amount of the ex-stamp duty. So now Mike said, long time listen, first time question, should I diversify with the 4 banks, or is it safe to have it in one? Diversify, I assume you're talking deposits. I could be wrong, but let's talk about deposits. So there is, of course, the 250k deposit scheme, which is government backed but not government activated at the moment. That scheme protects deposits up to 250k in any ADI listed by APRA. So go to the APRA website, you can see all the ADIs that are listed. And that essentially means that if a bank folds, those deposits are safe. Now, there are a couple of caveats. The first is there is a limit per bank of 20 billion per bank. So if you have one of the big ones fall over, the risk is that the limit would actually come in before all the deposits were actually satisfied. So my own strategy has been to diversify across multiple organizations and to steer clear from some of the biggest players to some of the still very well-known ones, and in fact some of the foreign outposts of banks from overseas here with a license in Australia on the APRA list are actually quite a good bet in my view. I think they're actually better run than many local banks. So I've spread the risks and I've kept below the 250k limit to diversify. What I would say though is that if you'd asked me 6 weeks ago, 8 weeks ago, I would have said avoid the big 4. The big 4, of course, are under huge pressure now, as you saw through the results. But, of course, the banks are being dramatically supported by the Reserve Bank and by the government. And I'm pretty sure that those banks will be propped up by government come hell or high water. So I don't think that they are hugely risky, less risky than I thought they were a few weeks ago. They have been building their capital reserves. They have cut back on dividends. They have, of course, put provisions up. All of that provides more protection, but they are still quite exposed. So my own sense is spreading the risks is quite a good, smart move. That's what I've done. Mick says, get the 8 billion from the Federal Reserve. Everybody else is. I have to say that's yeah. You know, I did a show a couple of weeks ago with George Gammon, and we spoke about the Fed and what they were doing. Right? Worth watching that show actually, because it's a remarkable expose as to what's going on. Basically, all that money is flowing to the banks, to the trading companies, to some of the corporates, who, by the way, did share buybacks last year and borrowed to do it. It's going to all of those big structural entities. Very little of it is flowing into real businesses. In fact, in the US, the way it works is that banks can essentially get funds from the Fed, and then the banks can lend that money on at a turn, so they're making a profit still. A lot of the money that was put up got grabbed quite quickly, so they've had to increase the program, the PPP. If you remember that particular show, I think I probably made a bit of a thing of the PPP, so go watch it if you've not seen it. But the point is, the focus is not actually on real businesses and real households. The focus is actually on corporates and the banks. And it's a bit the same here, actually, if you look at what's going on. With all of the initiatives and programs that have actually been developed so far, banks are actually giving interest holidays, but they've actually got a huge amount of money from the RBA. And now people are being given money to allow them to continue to pay the interest that they owe to the banks and those sorts of things. So it's a really weird structure. I personally believe we should have gone UBI, a universal basic income, and put that money directly into the hands of individuals and households to help them through this hiatus. That would have been a much more creative and I think a more immediate way. And if you're interested in UBI, I interviewed Guy Standing a couple of months ago, who's written a very good book on the power of UBI and why it's actually worth exploring. And his basic thesis is UBI is not just charity, it actually gives people the chance to become more complete humans and do the things they want to do, and it actually makes economic sense too. So worth watching that show. You can search on YouTube there and find Guy Standing. Okay. Mike says it's better to have 250k in all 4 banks, or can you keep it all in one? So, well, I wouldn't keep more than 250k in one organisation for the reasons I said. The government guarantee on deposits hasn't been activated, and it would have to be activated by the government. It would be overseen by APRA, and within a few days the money would come back. Right now, that is the critical scheme. But remember, there's also some vagaries about deposit bail-in. So. And I was watching something on the ABC earlier on in the Middle East, where over there banks are folded, and in fact deposits that were in the banks are now being used by the government over there to pay for government services. So that's the ultimate in deposit bail-in, right? There's no deposit bail-in happened in Australia. We'll talk about Emmy in a second. I'm sure somebody will ask that question. But the fact of the matter is that there is some risk of deposit bail-in. It's not a huge risk, I don't think, at the moment. Like I say, it looks to me as though the banking system is being supported by the government and by the Reserve Bank. So I think we can be relatively confident. But what I would do is not go above the 250k in one organisation, and shop around. And by the way, there are some quite good term deposit rates now available, because the banks need the deposits. So Westpac said, I think something like 70% of their book is now backed by deposits. That's a lot higher than it used to be. So that insulates them from the international capital markets. So they're very keen to get deposits. So I'd spread it around. And Mike said, hope the wife is getting better. Yeah, she's okay. She's had her scan, in fact, last week and passed with flying colours. So she's in the clear at the moment, which is huge relief. So we're just taking one day at a time, but she's certainly good at the moment. Mike, I get the point. Are the banks safe at the moment, or would you move the load? No, well, safe is relative. There's no such thing as absolute security, right? Gold is not totally secure. Bitcoin is not totally secure. Money in deposits in banks are not completely secure. Money held in cash under the bed is not 100% secure. There's no such thing as 100% security. It's all about trading off different types of risks. Like I said, at the moment, the amount of support that the banks have been provided with, directly and indirectly by the government, would suggest to me that the banking system here is as strong as it can be. It's much stronger than in many other countries around the world, and international investors believe that the banks here are ultimately backstopped by the government. So they have this unofficial guarantee from the government, and we've seen sight of that. So I wouldn't be too worried at the moment. And Mike says, love your streams. Thank you. Well, that's good. Gold Lad says, what about Mad Max outcomes when the oil runs out in 2086? Yeah. Well, by then, probably, hopefully, we'll have moved from oil to clean energy, because if not, then we'll have a bigger hole of an issue. So, the COVID thing has actually been a real wake-up call, I think, as to how fragile our economy is and how quickly things can go wrong. But consider this, that the long-term implications of climate change and all of the issues flowing off the back of that in a generation or two will be a quantum worse than the COVID impacts. So we could almost say that this has been a dry run for what we need to do, only more so later, to be able to deal with the issues around climate adaptation and all those things. And whatever you believe about the truth of it, the science is pretty clear that this is a real significant risk for the planet. And judging by our behaviour around COVID, doesn't give me a huge amount of confidence that we're going to be able to tackle the broader issue. But I would have thought by 2080, the oil will be a bit part player. Okay. Yeah, Plexus, thank you for highlighting my 90%. I think we fixed that. That was my typo. I was putting this together very late, the presentation. I had a lot of other stuff on today. I've had media people coming out of my ears trying to get more information about the mortgage stress analysis that I did and what I did on 7:30 last night. It's been a really, really busy time. So Goldlad says, do you get more revenue if we watch all the ads, or it doesn't matter? Yeah, actually, what's interesting is that the level of engagement around the ads just make a difference. So if you skip immediately, it doesn't work as well for me as, in fact, if you watch it through. So, it's there, and I make no apology for monetizing the shows. There's a lot of costs involved in just doing what we do here, apart from the gear that we needed to be able to make it work and, to stream reliably as we're doing tonight. The fact of the matter is that the costs of the research and the costs of everything else just add up. So it's how we actually cover some of the costs. It doesn't make a huge amount, but it makes enough to be quite helpful. In fact, the DFA business, so my research and surveys that I sell to a lot of organisations, are actually covering the costs of some of the stuff we're doing here. So I'm actually subsidising the channel, despite the fact that we get revenue and despite the fact that we get all of the contributions from you guys when you're on the stream and from Patreon and those things. It's not sufficient to cover all the costs, but I'm happy to do it. I'm giving something back because I think this is a really, really critical set of issues that we're dealing with, and I want to help people make better decisions. So, okay, whoa. I managed to flip forward and I need to flip back. Hang on. Okay. So Gold Lad asks, if there's a bank run in Australia, will this collapse all of the big banks? 9,000 banks collapsed in the Great Depression from the bank run, especially when deposits go negative. Yeah, so it's hard to know how this is going to play out. I mean, the banks are relatively well capitalised in Australia at the moment. We know there are some pressures on some banks. That The backstop, of course, is government support. And, in 2008, Bank West was bought by CBA and, St George by Westpac. Those sorts of consolidations could well happen again. The regulators, by the way, believe that it's easier for them to regulate a small number of larger players rather than a large number of smaller players. So they have this bias towards consolidation rather than actually innovation and creativity. But I don't think that the widespread run on the bank that some people are envisaging is what I see at the moment. Ask me in a few months, but I don't see it at the moment. Okay, ME Bank, what happened? This is Kent Chivas. Okay, so you've got a mortgage, right? There are two arrangements that you can have with the bank. One is that you have an account, and that account has a limit on it, and at any time you can draw up to that limit. So you pay down the loan, but you can draw back up to the limit again if you need to. And so people did that because it reduces the amount of interest that you pay, because you are effectively paying money in, reduces the balance, and therefore it reduces the interest that you have to pay. But what ME started to do was to reduce the limit on some legacy accounts, where effectively they now believe that if you didn't reduce the limits and you drew down or out again, you would not be able to have a structure to repay it. People got really surprised about this because they put large amounts of money in, expecting to be able to pull it out again later. That's not an offset account. An offset account is where you have a loan account and you have a separate deposit account, and the deposit account and the loan account are connected from an interest calculation, so the two are netted off, and you pay interest on the net balance. But they're two separate accounts, right? So what ME was dealing with was not an offset account. ME was dealing with an account with a limit that was bigger than the loan balance. So what they did was they wrote down the loan balance. So they didn't really steal money from people's accounts. They reduced people's ability to draw money back out to the limit. That's what they did. And they were doing it for a small number of accounts, essentially because they believed that there was a risk that they would have issues later because of the fact these were legacy. Now, the regulators are looking at this. I understand that there's been discussions between APRA and ME Bank, and we may well see some more, but that's what happened. And I don't think it's directly linked, by the way, with the fact that ME Bank is industry super supported, and some industry super funds are actually having issues with liquidity on their own super funds. I don't think those two things were particularly connected. I also made the point when I did my APRA analysis that ME actually securitized 4 billion of loans, mortgage loans, and took them off the book, which is why their balances dropped. Again, not completely connected to the liquidity question. Okay, Mike says, smash that like button. Yes, please, if you like what you see here, please smash it. Really would appreciate it. Now, Ant says, I don't feel the risk reward is adequate for leaving considerable cash in the bank at 1.8%. What are your thoughts? Well, where else are you going to put it? So that's the question, right? And it goes back to, why are you holding money in the bank? Are you holding money in the bank because at least hopefully it will still be there and you want it? Or are you trying to get a return? Now, frankly, if you look at the returns in the stock market recently, if you went at the right time, you might have traded up, you might have traded down, you might have lost, you might have gained. Some people will argue that holding gold is the way to keep value, and I've discussed this quite a few times. I'm not of that school. I think there are some risks attached to holding gold, particularly about what the long-term price of gold will be. It's highly manipulated. There are a lot of capital market instruments tied back to gold, and those move in different ways and at different times. So gold is not necessarily that secure. You could hold money in cash. You get zero for it, but at least you've got cash, unless it gets burnt or destroyed in some other way. Like I said, there's no completely risk-free option. So my own judgment at the moment, and I went to cash quite early, was that cash was the best option for me at the moment. And that's partly because of where I am in my life stage. I'm sort of heading towards retirement at some point. I can't afford to take huge capital losses at the moment, because that would be disastrous for my financial future. So for me, it's about protection more than anything else. And if I can get a little bit, so I do have term deposits, and I'm getting, a couple of % on those, better than nothing. Other people make different trade-offs. There are lots of different strategies out there. Some people are looking for significantly higher returns. What I generally say to people is, if you start seeing bigger returns, be cautious, be really, really cautious, because those returns probably signify greater risk. And, risk-return ratios work sometimes, but they don't always work. So that's what I've done. But other people might have different trade-offs, and I never give specific advice as to do this or do that or the other. Just remember, everything has risks. Bitcoin has risks, gold has risks, deposit has risks, cash has risks. Lending it to your friend has risks. Whatever you do, there are risks involved, I'm afraid. Now, Jack says, should private banks be allowed to create money? Well, yeah. This is, of course, one of those really interesting discussions where there's a fundamental philosophical point about how banks work. So most people assume that you give your deposit to the bank, and that deposit is then passed on, and the bank then lends it out again. That's how they think banks work. Actually, that isn't how banks work. Although I would say that when you pass that money across to the bank, you're making an unsecured loan. There is no guarantee that that loan is going to be repaid by the bank, and yet you happily pass your money across because you probably have a view that the banks are relatively safe and they're looking after your money for you. But it's an unsecured loan, so that's the first point. Second point then is, actually what happens is that banks create money when they need to make a loan. So if somebody comes in for a loan, the bank essentially writes, in electronic terms, writes a value of the loan. That creates money. That then flows to that individual. That individual then buys something with it or puts it in the bank. And so deposits follow rather than lead. And that fundamental flip is very important to understand, because it explains that banks will continue to create money for as long as there are people willing, or should I say mug enough, to borrow it. There is no limit. Now, banks have to account for it subsequently with the Basel ratios and that sorts of things, but it doesn't control what they do. That follows. So, should they be allowed to do it? My own view is it's actually unhelpful, because what it has done, it's inflated the amount of money in the system. As the amount of money in the system has been inflated, that's lifted home prices and stock prices, and everything else has gone up. And it just means you're chasing your tail, because effectively the value of every dollar is being devalued. And in fact, the super interventions from the central banks is just another case of the value of everything rising but not rising, so it's effectively being devalued. But central bankers don't buy this argument. Central bankers argue that it doesn't matter, because every time you write a loan, you create an asset on the other side, and those two cancel each other out, and you can have a lot of those or a little of those. It doesn't matter, because essentially there's no disequilibrium created by it. So they're wrong. I think I'm right. I think that we've got too much debt in the system. I think we've got nearly 200% GDP. That's a big deal. That's debt. That's income to loan, and it's 120 GDP. So these are big numbers, and we are over indebted as a species here in Australia, I'm afraid. True to an extent in other places as well, but our debt is very high. So my view is we've gone down this debt blind alley to the point where there's so much debt in the system that some of it will never be repaid. And that then creates a bigger issue, because if it's not going to be repaid, then it has to be serviced. And providing that people keep in jobs and can continue to service those loans, the Ponzi machine can run on a bit further. But of course, if unemployment rises and debt servicing then gets more difficult, that's at the point when it all goes terribly wrong. And unfortunately, that's what I'm looking at the moment with my higher levels of unemployment. So unfortunately, we're going to see the impact of this private credit creation. Now, there is an argument to say we've got to restructure the banks, stop them doing that, and basically coming back to a more sort of equilibrium-based view of way banking works. Probably unlikely it's going to happen, but it should, in my view. And unfortunately, central bankers are the ones who are driving this whole philosophy. Now, Harold says the National Bank will be subject to government mismanagement, cronyism destroying capital, picking winners and losers, which never works. I wonder, don't you think they do that now? I would say that they're doing that precisely now. No change. So even without a government-backed bank, unfortunately, what's happening at the moment is the private banking sector is still picking winners and losers, but they're preferring to pick mortgages rather than actually investing in businesses. So my question to you, Harold, is how do you get the investment into productive businesses that can create value for the future? That's the big question. If there's another way of doing it, I'd love to understand it. But at the moment, if you leave it to the private sector with the Basel ratios, they much prefer to lend to mortgages, and they'll go on writing mortgages until the cows come home for as long as people are willing to take ever bigger mortgages, inflate house prices, get bigger mortgages, inflate house prices, repeat, rinse a few more times. That's what's happening. Cookie Boy says remove stamp duty. Yeah, well, maybe. If you remove stamp duty, prices will go up. Harold says these ideas of central planners folly. Yes, they've been tried before and ultimately fail. Yeah, maybe. I mean, there is an argument to say we need to get back to local banks and people effectively owning the local community and the local responsibility. I really like that idea. I just am not sure whether it's feasible at the moment. But we have to find a different model from the one we've got today. That's my first point. And there are some different options and different models we can explore. None of them is perfect. But at the moment, we have a banking system that supports the banks and helps the bank shareholders to make good returns, but doesn't necessarily support the economy, support businesses and support households the way that I think they should. Now, Gold Lad says, do you think this will be 200 on the ASX will go under 4,000 points by September? No, probably not by September. I think it's probably going to take 18 months or so to really work through. So my expectation is we're going to see a tapering of the support mechanism starting in September, running probably till the end of the year. We're going to see 2021 a very troublesome year as the economy is trying to be brought back into existence again, and as unemployment maybe comes down a little. But then I think we've probably got more downside pressure on the ASX through 2021, 2022. And if you followed my conversation with Harry Dent, by the way, I'm talking with Harry again at the weekend, Harry's of the view, and I sort of share his view, that the falls we've seen so far are not the big falls. We've got another consistent period of sort of wobbling up and wobbling down, but there will be then a more significant fall later as some of the medicine that's been dosed out comes home to roost, and as the inflationary pressures build perhaps, or the recessionary pressures build. There's still a big debate as to whether we're going to have an inflationary future or a deflationary future. My own view is it's going to be deflationary. Look at what happens in Japan. Japan has the central banks owning massive amounts of Japan now, and we've got deflationary forces there. I suspect that's the sort of economic model we're going to have. In that situation, the ASX will go down rather than up. But it will not happen immediately. I think it's going to take probably a longer period, maybe a couple of years. Now, Otto says, interest rates have been artificially suppressed as a matter of policy. What are your views on the probability of market price of money reasserting itself in the near term? No chance. All the central banks are controlling money. They're controlling the yield curve. They are controlling the price of money, the volume of money. They will continue to do QE, and they will keep prices low, artificially low, for at least the next 3 years. So in the short term, no chance. Later, there is a risk as they start lifting rates, if they start lifting rates, that we'll start getting considerable rate hikes. And if in the inflationary future, which is one scenario that you could see playing out, you end up essentially with the need to see interest rates up a lot to try and deal with inflation. And there are people out there who believe that in that scenario, gold is the way to protect yourself because that does well in an inflation environment. But if you have a deflationary environment, gold does less well, and the value of assets decrease rather than increase. And as I say, I'm veering towards the deflationary future rather than the inflationary future, because I think we've just swamped the economy with so much debt, and therefore the chances of us being able to get interest rates to a more normal level anytime soon is close to zero. Thanks, Mike. Okay, any news or rumours about the cash ban that was supposed to be approved by the Senate? No, of course, Parliament's open this week for a business. We don't know of any intent to bring that bill back. I wouldn't be surprised to see that bill just quietly fade away at the moment, because it's rather been overtaken by events. But of course, the fact of the matter is that negative interest rates are still a risk later. And, there is a school of thought that's out there that says that you have to take negative rates lower by 4%. That's what the IMF said, into deeply negative territory to try and actually restart the economy. Major mistake if you do that. I did a post earlier in the week with German banks effectively starting to charge negative rates on some deposits. It's a very, very slippery one-way street. No proof that it's worked. Japan's got negative rates. No proof that they work. Major mistake, but it could well be. Now, Safa says, what do you think about glint for gold investment? I don't know what glint is. You'll have to tell me. Don't know what that stands for. Richie says, you posit that taking stamp duty away will raise prices, at least initially, but doesn't land tax incentives release of land alleviate the purported supply side constraints? Yeah, maybe. If you think that the supply side is really the issue. I'm arguing that we've got 1 million properties already here and available, and there's plenty of land around if you actually want to go deal with it. To my mind, supply side issues have been put out by the property sector for a long, long time. I'm not sure I believe it. So therefore it comes down to what the market will stand. The market will stand whatever the banks are prepared to lend. If in fact stamp duty is removed, banks will lend more, prices will go up. So that's how I see it. Now, Cookie Boy asks, what taxes do you believe will go up to repay the debt? GST? Soft drink tax? Medicare levy up? I don't know. It's an interesting question because Frydenberg today ruled out effectively some of the levers that you could use to repay the debt. And of course the MMT guy said, no, you have to repay it. It's all right. It's the sort of debt that you can just go on servicing forever, particularly at these really low interest rates. So there is an argument for saying you never have to repay it. I don't buy that. I think the debt ultimately has to be repaid. And then the question is, well, what do? Do you actually throttle back services? Well, Frydenberg said, no, we don't want to cut services. Okay. So do you want to lift taxes? No, we don't want to lift taxes. GST is not going to go up. Well, you're running out of runway then. What are the choices that you've got? And at the moment, there's no credible plan that I see that the government has to deal with the debt other than to try and get very strong growth and to basically grow our way out of it. Good luck with that. Other people have tried that around the world and have not necessarily been very successful. Tom, thank you very much. W, thank you very much. I appreciate those contributions. Really helpful. So Ron says, what's going to happen after September this year when all this stimulus money stops? Well, the chances are, as I've suggested, it's going to be tapered. I think if they turn it right all off on day one, that's going to be a major disaster. We're going to see unemployment spike. We're going to see a lot of people out of work, and we're going to see a lot of people with mortgages they can't service. So they've got to taper it. I suppose they'll hope that the economy will begin to pick up and support it. I have my doubts about that, particularly from what the Reserve Bank said today about unemployment next year at 7%. It's going to be really tricky. That's one of the reasons why I haven't taken my modelling to September yet. I've gone to August because I'm not sure exactly how it's going to play out. I think the second half of the year and then 2021 is going to be really dicey for the reasons that I've discussed. Sovereign Borders says, based on expert analytic expertise, who would win in a one-on-one fight between Phil Lowe and Jerome Powell? What sort of odds is the winner showing? Oh, well, I think Jerome Powell will win just because he's got more money to play with. He's got a bigger economy, right? So he's bigger than Phil's. And look, I'll be honest with you, Phil has come late to the party, right? So he's following the same path. Powell is a bit leading the way and saying, well, to use all the tools in our kit bag, we'll do whatever it takes. You're starting to see Phil say the same. So I'm afraid that Powell would win hands down. Vanessa says UBI is slavery, in my opinion. Yeah, it's an interesting discussion, Vanessa, and it's not perfect, but there are, I think, some interesting and rational reasons to consider UBI. But it is a very different philosophy from the one we've been used to. So I understand what you're saying. Would UBI be different to current welfare? Yes, it would, because it's not tied to anything, and it's basically a level of support that allows people to do whatever they want to do. Go watch that show that I did with Guy Standing if you want to know more about UBI. He's run some schemes and tests with these particular strategies, and they actually are remarkable in terms of their empowering individuals and creating better outcomes as well. So it is a different philosophy than welfare, and frankly, welfare is seen as crumbs off the table. This is a different philosophy. It's enabling things to happen. So go watch that show. In what year do you think cash money will become extinct from Gold Lad? Well, the banks are trying to do all they can. So did you see that they sent out these debit cards to people with the passbooks, and they've actually upped the limit of that you can use on a card and those sorts of things. The banks would love to get rid of cash because it's very expensive to manipulate and handle and deal with, and it's expensive to store and all those things. So that's one of the reasons why the banks are very keen on the cash ban and getting rid of cash. But as we've argued a number of times, we're giving up freedoms that we have today. We can go pay for things in cash. I think we should still have that freedom, and also we should have the freedom to be able to take money out of the banking system rather than being trapped in a banking system where banks could start charging us for transactions and tracking us in the system. But there are countries around the world where they've taken the journey towards a cashless society and then done a U-turn. Some of the Scandinavian countries, they've woken up to the fact that they've actually locked themselves into a future where the financial system is controlled by the payments system, the payments network, and who manages the payments network. So they're now putting limits on what that can do and bringing cash back. And in the US, they have legislated to make sure that, for example, in New York, that cash is available still. So there's an interesting tussle. I don't think it'll go as quickly as many would like in the banking system. Quickie Boy says term deposits have dropped again. Yeah, that's because there's a supply and demand issue. But the rates are still somewhat higher than they were, but still not flash. Now, Andy says, what's the chance of a realised CPI inflation spike followed by deflation? Yeah. Well, of course, it depends how you measure CPI. As I've argued several times, the CPI measure that is used is a Mickey Mouse one. It doesn't really give you the full read. They do a lot of adjusting and those sorts of things. I think that we will see spikes in CPI because of the costs of goods and services, and also the fact that later I suspect that some of the stuff that we're used to getting from overseas will be perhaps more expensive. On the other hand, oil will be very cheap, of course. So, we'll have to wait and see about that. There is a question in Mark, as I discussed earlier on, as to whether we get a deflationary or an inflationary future. In an inflationary future, you get CPI running quite hard. In a deflationary environment, it goes the other way. So I'm of the view at the moment, the chances of the Reserve Bank getting anything close to 2% in the next 3 years is zero. They're going to be well under it for a long time. So my own view is CPI is going to be pretty benign for a long time. Ricky says, what do you think about investment banks such as Macquarie? Well, Macquarie, of course, is a good franchise and it's created huge value for its shareholders. It does it in a series of mechanisms that sometimes you question, I think, from an ethical perspective, and you question in terms of some of the business practices that they get involved in. They've been lending hard on mortgages, both investors and owner-occupied mortgages in Australia, and they've been doing a lot of trading, so they've actually been able to leverage into the current crisis quite well. They are a global player based in Australia, but with global influence and reach. But do I have money with Macquarie? No, I don't. Jeremy says, I see from your scenarios you don't see negative rates in the near term. Why? I think that we will see rates sitting at 0.25% for a long time. Lowe has said he doesn't want to go negative. The real bounds is actually 0.1%, not 0.25%. That's the rate at which the Reserve Bank effectively transacts at. So that's the lower bound at the moment. I am not convinced that the Reserve Bank believes that negative rates actually are going to make a huge amount of inroads at the moment. They may have to change their mind later, but all the evidence from around the world is that negative rates don't work. So maybe we should hope that they never come here. Food and water is worth much more than gold. I agree, it is. Yeah. Judy says, will they revert to ATM capital controls on deposits after all these payments stop? I don't know. It's difficult to know precisely how this is going to play out. Clearly, they can put limits on ATMs, and they could do that. But I think that the banking system here will remain relatively resilient, supported by the government. They think it's really important that it maintains its momentum. So I wouldn't be surprised to see those sorts of controls here in Australia anytime soon, but I could be wrong. Do I think money is safe with ME Bank? Yeah, I think it's reasonably safe compared with other organisations at the moment for the reasons I said. Moody's actually called them out as one of the banks that would need to be able to actually put more funds in to support its capital ratios, but it does have those industry funds to support it, and it actually is, believe it or not, quite well managed, so I wouldn't be too worried. This is from Jack, do I think Freidenberg will end up tapering the JobKeeper? Yeah, as I said, probably September to December, that sort of time frame, but it depends a little bit on how quickly COVID goes away. Ampamp says, will you be considering some cheap bank stocks in the not too distant future for a long-term hold? Well, actually, I do hold a few bank stocks, but I bought them years and years and years ago, and up until now, they've been actually very handsome dividend payers. Would I buy bank stocks at the current prices? No, I wouldn't. I would actually, because I think prices, they're still overvalued based on what I'm seeing at the moment. So I would still not buy any more at the moment, even at the current levels. I'm expecting prices to correct further ahead. Okay. Now let's just have a look. It's 9:31. I'm pretty much coming to the end. I haven't quite got to all the questions. How safe is it presently to be banking with Kudos? Now, Kudos, of course, is the ex-Qantas bank, the old credit union Qantas. That is definitely another one that's got issues because, of course, a lot of those particular employees are now not working. I don't have any inside information about that particular bank, but it's probably not one that I would sort of veer towards in the current environment. Now, Mike asked about the geopolitical landscape and our relationships with the US and China. How does the future look for Australia if the US and China trade wars worsen? You know, this is a really interesting conversation. I've done a couple of shows on the China-US axis. I've got another show to come on that as well from somebody else, because there are so many diverse views about how this is going to play out, from people who think that China's going to take over from the US, to those who think that our relationship with the US is so strong that it will never change, through to those that the trade war will just bubble up again and will be caught in the crossfire. It's very hard to know. I'll get more information from the more people I speak with, and I'll put some of that up on the DFA channel. I haven't formed my own enough of a certain ideas yet to really form my own views on that, but it is a very important and great question. Cookie Boy says, new car sales figures 48% down, job losses galore. Yeah, in fact, I did have data on car sales, but I forgot to put it in the presentation. I didn't get round to it, but yeah, and a lot of those were actually, just domestic cars, and the utes were a bit higher, a bit more used, but yeah. This is a really important bellwether, I think. I agree with that. Now, Robert says, do you think US Treasury bonds safe in the current environment? Yeah, I don't think US will default. They'll just go on printing money. So the returns won't be great, but I don't think they're going to fall over. Now, Brandon says, would you be comfortable redeploying your capital into other assets other than cash? Not at the moment, I wouldn't. Too many risks. Be it property, be it gold, be it Bitcoin. So I'm happy where I am. I'm going to stay there. Okay, well, what I'm going to do is just come back to a few closing slides, and then I'll just have one last look at the stream here. Just to say, if you want more information about what we do, the DFA blog contains a whole lot of data, a lot of posts, a lot of information. Go have a look. You can sign up there to get free alerts. You can also support our work. Some people do that via Patreon. You can subscribe to on a monthly basis. You can get access to additional content, including, for example, the information that I shared with 7:30 on Monday. So you can see that whole interview if you're interested in that. So that's available. Patreon's quite a good way because people actually then contribute on an ongoing basis. I really appreciate that. And so have a look at that if that's of interest, or you can make a one-off donation via PayPal if you want to do that. Again, people prefer sometimes to make one-off donations, and that's a way of doing it. Relatively simple mechanism, or indeed Bitcoin. So we do have a QR code that few people have used. However you like to support us, we are really appreciative. It all goes to helping us to make great content. Just to say that we got this DFA design on Intelligent Insight today, and that has been flowing into some merch. Had a few people go grab it, so if you're interested, there's a few different colours other than those. Feel free to have a look. I'm not pushing it particularly hard, but it is there if people are interested. And again, it helps to just cover the costs of doing what we do. Top hits this month. The bank that could save Australia. That's the conversation with Robbie Barwick about the bank that is required to restart the economy. The world just changed. The DFA Daily has actually proved to be really positive. These sort of quicker daily updates. So we're doing those every day. But that was a really important one because it really highlighted that pivot that happened on the 15th of April. I discussed negative interest rates a little while ago. That's been a very popular show because people weren't actually getting their heads around negative interest rates. And then on the 14th of April, we also had another amazing pickup from there because, again, we were talking about this sort of transition that was going on. And then Tarek Brooker and I discussed the 2 time bombs. So relevant, that conversation that Tarek and I did, so it's worth watching if you've not seen it. And then Harry Dent and I discussed a couple of weeks ago why there are still more falls ahead. And I think I mentioned we're going to talk to Harry again in a few days, and we're going to get his latest thoughts on what's going on. I like Harry because I can just turn him on and off he goes. But no, seriously, he's got some really important points, and it's quite interesting to hear what he has to say. Okay, the next live post will be on the 19th of May, so 2 weeks from today, and that'll be the day that the minutes from the Reserve Bank's meeting come out, so there'll be a lot more information. I'll have some more data as well on the issues regarding forced sales and some updated information on the incomes of households. Okay, so I'm just going to come back to the posts and just see whether I've missed anything. I'm sure that I've missed some questions, and don't take it personally if I have. I do apologise. If there are questions that you'd like me to follow up separately, you can send them to me on the DFA blog, and I will make another show like I did a couple of weeks ago where I actually go through the questions that are actually being asked. But actually today I think I've managed to pick up quite a few of them. It's interesting getting a few of the comments. Gold Lad said, "You've made me wish I said economics at school instead of doing a trade 20 years ago. You make it so easy to understand." Cheers. Well, thank you for that. I do try. And here's a secret. A lot of the stuff is jargon, and it's designed to be complicated deliberately, because by making it complicated, people think they can earn the big bucks. But the fact is, it's actually not that complicated. Don't tell anybody. Okay. Mike says, "Thanks for being me." Well, that's good. Thank you. Thanks for those posts. I appreciate that. Well done. Thanks for moderating tonight too. Let's see whether I missed anything. No, I think I pretty much got everything. Okay. Well, at 9:38, with a peak concurrent of over 800, so cookie. I think it's probably the RSPCA this time. there we go. So thank you for your time today, and I appreciate your spending some time with me. I'm so flattered when people choose to spend some of their evening in my company. It is an amazing experience every time I do this. I love doing it, and I hope that I'm able to help share some of my insights and thoughts, and also not necessarily give you definitive and packaged answers, but help to develop your own thinking and understanding, because that's what DFA is really about. So we're going to be back in again on the live stream in a couple of weeks. We'll be making daily posts over the next few days. We've got a whole load of new interviews lined up, so that'll be interesting, and I'll look forward to sharing those with you. And meantime, I just want to say thank you for your time tonight. Take care, and we'll see you next time, and keep safe and keep well. Martin North from Digital Finance Analytics signing off. We'll see you next time.